Hey investors, are you ready to turbocharge your trading profits? Today, we're diving headfirst into the exhilarating world of scalping. This isn't for the faint of heart. We're talking about high-speed, high-stakes trading where fractions of a second can make all the difference. Get ready to learn the secrets of scaling in and out like a seasoned pro. I'm talking about minimizing your risk while squeezing every last penny out of those market moves. We're going to break it all down step by step so you can start scalping like a pro. Alright, let's break down the basics of scaling in and out. Think of it like building a house, brick by brick. You don't just slap the whole thing up at once, do you? No way. You start with a solid foundation and carefully add one brick at a time. It's the same with trading. Scaling in means gradually entering a trade with smaller positions instead of going all in at once. This way, you're not risking your entire portfolio on a single roll of the dice. Then there's scaling out, which is like taking profits along the way as your trade moves in your favor. You're locking in gains and reducing your risk exposure. Remember, slow and steady wins the race. Now, you might be asking yourselves, why bother with all this scaling business? Well, let me tell you, the benefits are massive. First off, you're mitigating your risk like a pro. By scaling in, you're avoiding putting all your eggs in one basket. If the trade goes south, you're only exposed to a small portion of your capital. Plus, scaling in and out gives you incredible flexibility. You can adjust your position size as the trade develops, adding more as it moves in your favor, or cutting your losses early if things take a turn. And the best part? You can maximize your profits by capturing gains at different price levels. We're talking about squeezing every last drop of potential out of those trades. So how do you actually execute this scaling magic? Let's break it down into a simple step-by-step guide. First, you need to identify those high-probability setups. Look for stocks with strong momentum, high volume, and clear breakouts. Once you've spotted your prey, it's time to enter the trade, but remember, we're doing this gradually. Start with a small position, maybe 25% of your intended trade size. As the trade moves in your favor, you can add to your position, scaling in with another 25% at key support levels. Now here's where things get really interesting. As we're scaling in, we always want to protect ourselves with those stop-loss orders. Place your stop-loss just below your entry price or a recent support level. This way, if the trade reverses, you're automatically out with a minimal loss. And as the trade climbs higher, make sure to adjust your stop-loss accordingly, locking in those gains along the way. Remember, we're not in the business of giving back profits. Now, when it's time to exit, we're going to scale out in increments, just like we scaled in. As the stock approaches your target price or shows signs of weakness, start selling off portions of your position. You can sell 25% at the first sign of resistance, another 25% as the momentum slows down, and so on. By scaling out gradually, you're maximizing your profits and minimizing the risk of getting caught in a sudden reversal. Listen up, because this is crucial. Scalping involves rapid-fire trades, so risk management is non-negotiable. First and foremost, never, and I mean never, over-leverage yourself. Only trade with capital you can afford to lose and use appropriate position sizing. A good rule of thumb is to risk no more than 1 to 2% of your account on any single trade. Remember, it's all about protecting your hard-earned capital. And don't even think about entering a trade without those stop-loss orders in place. They're your automated bodyguards, protecting you from catastrophic losses. Keep a close eye on your risk-reward ratio. Aim for trades where the potential reward is at least twice the risk you're taking, and for heaven's sake, don't be a hero. Avoid overtrading like the plague. It's a slippery slope that leads to emotional decision-making and, ultimately, losses. Stay disciplined, stick to your plan, and only take trades that meet your criteria. Remember, the market is a wild beast, and it can change direction in the blink of an eye. Always be prepared for the unexpected and adapt your strategies accordingly. Don't be afraid to cut your losses if a trade isn't going your way. There's no shame in admitting defeat and moving on to the next opportunity. And most importantly, never stop learning. The market is constantly evolving, so stay ahead of the curve by continuously educating yourself and refining your skills. Listen, I'm not going to sugarcoat it. Scalping is risky business. But for those who dare to master it, the rewards can be substantial. Remember, discipline and patience are your best allies in this game. Don't expect to get rich quick. It takes time, practice, and a whole lot of grit to become a successful scalper. Before you even think about diving into the real markets, test your skills in a demo account. It's like training for the big leagues without risking a dime. And when you do finally step up to the plate, start small and gradually increase your position size as you gain experience. So there you have it, folks. Now go out there and start scalping like the pros.